Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press *0. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Thanks, operator. Nick Hamilton here alongside David Burrows and Paul Campbell. So thanks for joining us. Hope you've been enjoying the summer weather and the little preview of the fall weather. So since the last call, we've seen volatility edge higher as investors digest stronger U.S. GDP numbers and what that could mean in terms of higher rates, as well as weaker economic data out of Europe and troubling geopolitical events. More recently, we've advocated to buy on the dips that we do see based on the belief that we have numerous tailwinds for equity markets, clearer leadership, and an improving appetite for investors to own equities. Probably the most material thing we've witnessed recently, however, is better than expected earnings from U.S. and Canadian companies, which we think further adds to the case for North American equities to continue their advance. Now, I'll let Dave and Paul comment in more detail because I know we've been active in making tactical changes to get our investors on side. But before I do that, there are a few performance points I'd want to make on our mandates. The investment climate has really played well into our hands over the last 12 months, especially with the pickup in economic sensitivity and with a shift in leadership that we observed, about midway through last year. So the Barometer High Income Strategy is up 9.3% year to date, with the High Income Fund actually ranked second out of 750 funds in the Morningstar universe over 1 year. The 1 year rate of return is 21.2% versus the peer group at Morningstar 15.2%. So there's some good alpha being generated there. The Barometer Disciplined Leadership Equity Fund, which we launched in January, only has a short-term track record, but it's up close to 11% year-to-date and also ranks second out of over 1,000 funds in the global equity peer group. And this is over the short term. Other notable results would be the Barometer Long-Short Equity Pool at 12.5% year-to-date, and this is versus a landscape of hedge strategies which have really struggled in this environment. And lastly, I'd highlight the Barometer Tactical Balance Pool, which has returned 11.6% year-to-date and has done so with a conservative mandate and maintains a minimum of 25% fixed income at any given time. We're seeing some increased interest from private investors looking to invest using a balance profile, so we'll keep you up to date on that story with more to come. So at this point, I'll turn the call over to Dave.
Great. Thanks, folks, for joining the call today. What I thought I'd do is just give a quick sort of high-level view as to what we've been seeing going on, sort of through the Barometer lens. As everybody knows, we take a top-down view to try and target and identify, the key leadership themes market-wise, where we're seeing money get put to work and try and target those neighborhoods, and perhaps avoid some of the groups that are seeing net outflows using the breadth models that we use. And then within those camps, try and find specific ideas that we believe have the characteristics that could lead to revaluation versus the peer group. So through that lens, just to start from the top down, over the last 5-6 weeks, there has been a little bit more volatility. We did certainly see some of our short-term indicators wobble. But having said that, we have been of the view for some time that unless we were to get significant change to our long-term models, we're more likely to be seeing short-term dips. Turns out we've had the ninth 2 to 3% correction since 2012. Every single one of those has run into a wall of buyers, and despite a fair bit of macro noise, this market seems to want to go higher. All 4 of our short-term indicators have turned back positive as of last week. Many of the leadership groups trading back to or through the highs, including the NASDAQ 100, and certainly the leadership themes do seem to persist. So when we look at that and we say, why is it that the breadth models are hanging in as well as they are? Certainly, geographically, North America is performing the best versus versus the broad developed markets. Europe has been a little bit weaker. Of course, we have very little exposure there. And we have seen a little bit of expansion in breadth and improvement in Asia in particular, which is certainly not hurting sentiment. If you look at why that is, why breadth models seem to be holding in well, if you look at the economic data over the last month, 10 of the 12 leading indicators have been higher than they were the previous month. In fact, almost all of them have moved higher 3 months in a row. So we're seeing leading indicators improve. When we look at the earnings coming out of the quarter, Russell 1000 delivered, 70% of companies beat estimates, which is the best quarter we've had in many quarters. 63% of companies beat on revenues, and we are seeing good revisions coming into the back half of the year for the first time in the last 3 years. In the last 3 years, we've consistently seen revisions lower in the back half of the year. Revisions are going higher at this point. So that leads to some CEO certainty. There's money being spent on buybacks. There's money being put to work in acquisitions at significant premiums, and we're certainly seeing dividend growth. As you know, it's been our view that this market is being driven by two things, improving earnings and improving multiples. The one thing that I would highlight that is consistent is that in North America, we are seeing both expanding multiples and growing earnings. Europe had been seeing expanding multiples. The earnings have been the problem, and I think that's why you're seeing some mushiness there. When we look at asset classes, stocks as of yesterday hit a new relative strength high versus commodities as an alternative, further supporting our view that commodity super cycle has long been over and is certainly good for inflation. Now, that also is helpful to the U.S. market. 72% of the U.S. economy is the consumer. We know that their debt servicing costs have been coming down. The commodity tax or inflation has been coming off the boil. So inflation has been muted, and that's certainly playing through into interest rates. The one commodity that had been strongest, energy, in particular oil, both in terms of WTI and Brent, has been backing off over the last few weeks. That's had some impact on the energy patch, but has had a positive impact on things like consumer discretionary and healthcare. And despite the fact that lots of people continue to look for higher sovereign bond yields on stronger economic growth, U.S. yields have remained very muted. The one thing that we would highlight on that is that when you look at the yield on a 10-year U.S. Treasury bond versus a German Bund, there is an enormous spread between the 1.1% a bond and 2.4-ish% on a 10-year U.S. bond, and that probably is leading to a fair number of dollars be purchased by offshore investors to use to buy Treasury bonds. That's holding yields down. It's also serving to continue to strengthen the dollar. So the dollar has been firming now in fits and starts over the last 3 years, but in the last 3 months, there has been a marked acceleration in the strength of the dollar, and that's virtually against virtually all currencies. Interestingly enough, out of the basket of about the top 25 currencies, the gain versus Canadian dollar has been about the smallest. So we've seen less strength versus the U.S. dollar, but certainly against all currencies, U.S. dollar has been very, very good. If you look at previous periods where you had strong dollar, like, for instance, the 1980s or the 1990s, in both cases, there was a very high correlation, strong U.S. dollar, strong equity markets. If you look at periods where dollar was weak, like, for instance, the 1970s or the 2000s, in both cases, markets worked their way sideways. So strong dollar and strong stock market consistent with secular bull markets, and that's sort of a case we've been making for some time. Now, from a sector perspective, we spent a lot of time over the last 3 years talking about the boom in U.S. energy production and what that could mean not only for the energy industry but for industrials and the consumer. Of course, that continues, and that continues to support the performance in our biggest sectoral weight, which would be energy infrastructure. We hold energy infrastructure names both in our equity and our income portfolios. I think they have continued to surprise investors both on the earnings front and the dividend growth front. Companies like Pembina and Keyera and AltaGas continue to perform exceedingly well, hitting new highs regularly. And this theme looks to continue with the move toward liquefied natural gas and the opportunity there. The one thing that we would say is that on the back of some of the weakness in crude, we did see a turn down in the breadth models of the producers and some of the service companies. So whereas a month ago, if we were looking at the equity portfolio as being close to 40% energy, made up of infrastructure, yield-oriented names, and growth producers, you will note that if you look at the holdings today, the weighting would be roughly half that, in the low 20% range. And that has been on the back of some reduction in some of the growth energy names. It may be in October we look back, we'll say, well, it was seasonal and energy's firmed back up again. One thing we would note is given all of the macro noise in the Middle East and around Russia, it is surprising that we've seen nothing but weakness in energy prices. So that certainly has caused us to pull back our horns on the energy exposure. Having said that, some real positives for other sectors. We've seen very good strength, continued strength in technology. We've seen very good strength in Canadian financials, banks and asset managers. We've seen nice resurgence in the consumer discretionary sector. Industrial's been quite good, and of course healthcare just continues to charge along and make new highs, and that's across a number of different camps within the healthcare space. So if you look at the portfolios today, high-income portfolio, biggest weight would be financials, sitting at about 36%. Energy, which is where our big weight in midstream energy, would be in the high-income portfolio, about 32%, followed by materials, industrials, and technology. We're seeing very good dividend growth. Average company's given us 15.8% dividend growth so far year to date. That's in excess of what we're seeing in the S&P. No shortage of cash available. Corporations have just hit new highs from a cash perspective, so we expect to continue to see dividend increases, share buybacks, and acquisitions. Dividend payout in the S&P still is just below 35% at 34.4%, but working its way higher. So very pleased in general with how the income portfolio is going. On the equity side, as we mentioned, we've been carving back the energy weight. What I thought I'd do is I'd ask Paul Campbell to talk a little bit about the destination that some of that cash has found its way to in some of the newer names that we've been adding to portfolios and some of the value that he's been bringing to the table.
Great. Thanks very much, Dave. Just to highlight two large cap U.S. stocks that we have been adding to. The first is Archer Daniels Midland in the food processing area. This is a global giant in the business of processing oil seeds, corn, wheat, cocoa, and other ag commodities. It's also really a logistics network, global logistics network for sourcing and delivery of raw materials and processed products. As I mentioned, it is a giant. The market cap's over $30 billion. The stock has been doing well. It's got a history of good performance. It's well managed. But there's some particularly positive factors that I would highlight that we believe is going to continue to drive ADM's earnings. Number one would be the huge corn and soybean crop that is lowering input prices. Given that Archer Daniels is a transporter and a processor of commodities, higher volumes is good news for them. Also, the lower prices helps to drive end market demand. So that's expanding their margins. This is really quite the opposite of what the fertilizer and other input producers are seeing where we are not present. They are being hurt by the weak ag commodity prices. The global logistics supply chain that Archer Daniels Midland has is really, again, a way that they can benefit from the very large crop. There's going to be a variety of displacement opportunities in the markets, and the crop is going to need to be moved, and ultimately ADM's in a good position to benefit from that. As well, the company has been moving up the value chain, which offers margin expansion opportunities. That's going to continue. And then finally, ADM is big in the ethanol area, and pricing has been positive, driven by emerging markets import demand, which has been growing, and pricing remains firm. And again, on the And the corn pricing side, where the prices have been weak, that really helps their margins. You add it all up, ADM has a very good outlook, and it's trading, in our view, at a very reasonable below-market multiple of a bit under 15 times forward 12-month earnings. The second large-cap U.S. stock I'd highlight, we recently moved back into, is Home Depot. They reported very strong second quarter earnings results. The earnings were well ahead of estimates. They were up 22% year over year, which is a good result. But most importantly, their same-store sales comparable numbers grew 5.8% over the past 12 months, and that's probably the single most important metric for a retailer. That compares with 4 to 5% expectations. The company is very well managed. As the sales have grown, their costs have come down. They boosted their EPS guidance for next year. The sales growth guidance has been maintained. There's also been some positive developments in the economy. Housing starts and housing permit numbers, which were out earlier this week in the U.S., were strong, which highlights that the housing recovery has not been abandoned. It's ongoing. It's moving with fits and starts, but it looks like it's set to improve. The stocks reacted very favorably to these results, but we see additional upside. Company generates strong free cash flow. They're very disciplined in their capital spending. They have surplus cash, which they're using to buy back stock. They've already bought back $3.5 billion this year, and they're set to buy back another $3.5 billion in the second half. Again, it's trading at very reasonable 18 times forward 12-month earnings, very reasonable given the outlook that we see in the quality of the business. And finally, financial I'd like to highlight, it's a smaller cap situation in Canada, is Calidus Capital. They went public in April of this year at $14. It's trading above $22 today, so it's done very well. We participated in the IPO and have added subsequent. Essentially, Calidus provides short-term collateral-based bridge loans to companies with short-term financing needs. They really focus on a niche in the market that is too small to issue public high-yield debt, but also in the part of the market where the banks really don't want to deal. This is very work-intensive, due diligence-intensive type of lending. The average yield on the loans is 21%, highlighting they're not risk-free, but Calidus has very strong management, and they mitigate the risk by very closely monitoring the loans and the borrowers, and they know the industries that they're lending to extremely well. They have their own information systems that track the performance of the businesses, so they know as much about what's going on in the business as management. They're focused on Canada, but they're selectively growing in the United States. The loan book is growing rapidly. It's already well ahead of expectations that were put out when they went public. It looks like they're going to have a strong end to the year. They've added some individuals in the area of origination, and they've got an infrastructure that's capable of supporting a substantial amount of growth. So really, as the loan book grows, that will feed through to rapid earnings growth. Again, it's a very well-managed company, and it's trading at 15 times forward 12 months earnings, and we see a lot of upside here.
Great. So I think that the takeaway here should be that, depending on the theme, there are a number of leading names that we can focus in to try and take advantage of what may be sort of secular shifts taking place in the underlying economy. You've got broad weakness in commodities, which looks like it could go on for a while. Certainly within the commodity space, grain prices have backed off. Volumes are going to be very strong. Archer Daniels there to take advantage of that. In the consumer side, pent-up demand in the housing and home improvement space, low costs of financing, debt servicing coming down, inflation coming down, consumer spending a bit more money, and certainly Home Depot taking advantage of that and pressing their leadership position in the industry. So, I think that we continue to be in the right spots. The big weights, as we mentioned, would be financials, energy, technology, healthcare, consumer discretionary, and industrials. If you were to go through each of the various portfolios we're focused in, these would be the key themes, and we're really quite pleased with how things are going. When we look at the big picture, it does look to us that we continue to be in a secular bull market. We're getting good earnings growth, and we're getting PE expansion, and so long as that is the case against a muted interest rate backdrop, we think we have a good combination. Just to mention one more time for those that weren't in the call last time, a lot has been made about the fact that this rally has had a lot of longevity. I think that we are coming up on something like 680 days, 675 days without a 15% correction. Just for those who don't know, if you went back to the 1990s, you had a rally that lasted just under 2,000 days, 1,928 days, or roughly 3 times as long as the rally we've enjoyed over the last while. In the 1950s, we spent a lot of time talking about the 1950s in the past. Market rallied 2,100 days without a 15% correction. So markets rally in price and they rally in time, and we're certainly getting some price improvement, but this could go on for a while. We see no major markers that would point to significant correction either in the breadth models that we use, in the economic data, in the earnings data, or the key factors that tend to be in place to get a significant correction. So here we are in August. August and September can always be funny months. Things can change. We just anecdotally would note that this market seems to be handling bad news extremely well, and there do seem to be buyers prepared to step in to buy the small dips that are taking place. So we look forward to the fall, look forward to a good fourth quarter, and hope you all enjoy the rest of your summer.
Great. Thanks, Dave. So there's some food for thought in terms of what we're seeing as it relates to market leadership, what our breadth models are showing, and some of the action we've taken at the portfolio level. I think Paul did a good job of highlighting 3 names we've been active in more recently as it pertains to those changes. As always, we do our best to remain watchful of the risks and opportunities that we do see and try to continue to maintain a high degree of transparency to our supporters. We've said for a while that investors really need to refresh the way that they look at equity markets today with many tailwind forces at play. And Dave mentioned a few of them: PE expansion, earnings per share growth, falling inflationary inputs, stronger U.S. dollar. These are all traits that are helping to push equity markets higher. So to summarize, I would say that we continue to be in an environment which favors focused managers with really flexible mandates that have the ability to make nimble moves and to capitalize on constructive and durable themes. So at this point, we'd like to open the call up to Q&A. Operator?
At this time, I would like to remind everyone, in order to ask a question, please press